The 6,000 crores, actually, the asset should increase by, let me put it this way. If my assets are 9,000 crores and 2,000 crores, if that is my profit, it get invested in assets, they should have become 11,000 crores. But actually what has happened? The net assets have gone down by 1,000 crores. What should have gone up by 2,000 crores has actually gone down by 1,000 crores. How does this happen? An off-balance sheet adjustment of 3,000 crores. How do you adjust it? Reduce the fixed assets credit by 3,000 crores and debit to retained earnings directly in the balance sheet. Directly in the balance sheet, you reduce 3,000 crore from the accumulated profits. And this is being done by many companies. What do you do in such case? ROC will not have even the time to see all the accounts, because the number of accounts which are filed and needed to be checked are huge. And there is no way one can go through all of them. So therefore, what is the tool for this? Bringing in this transparency. XBRL. We will discuss that, how XBRL will ensure that such kind of challenges are taken care of, direct off balance sheet items. Coming back, so this is the assets format. Now we go to the equity and liability format, which talks about share capital, retained earnings, other components of equity, and non-controlling interest. The non-current liabilities are long-term borrowings, deferred tax, and long-term provisions. And the current liabilities are, I don't have to read out to you because you are all aware of this. So equity has become a separate head. You don't see a head provisions, you don't see a head secured unsecured loans. And this format is nothing but now one which is copied in the revised schedule 6. So therefore, when you ask the ministry informally that, sir, why are you not bringing IFRS? They say, we have brought revised schedule 6 and we have recommended AS 30, 31, 32. Please come back to me and tell me unofficially, is there anything left to be brought in? So please don't be under the wrong impression that IFRS is yet to be declared, because 70% of my practicing friends, they say that Mr. Bhave, IFRS is gone. I said, fine, it has come under the different name. IFRS allows both the formats, and that's where luckily President Gopal Krishnanji is here. IFRS allows a format which is, in my young age, I mean physically young age, mentally I am still young. My young age, I have learned department-wise P&L account, and cost and management accountants are champions of the function-wise P&L or department-wise P&L. Therefore, you can see the heads here. I hope it is readable. Distribution cost, administration expense, finance cost. These are nothing but the department-wise P&L account. And according to me, if India decides to adopt function-wise P&L account, then it makes a great sense. Let me share with you the current issues. What are the current issues? IFRS allows function-wise as well as nature-wise. Or, let me show you both the formats again. This is a function-wise format. You are seeing only 3-4 lines. And if you go to the previous format, okay, I think there is a format done later. Yeah, here. This format is nature-wise. Raw material consumed, employee benefits, impairment of property, plant equipment, etc. So, what is the issue then? If we have the nature-wise and function-wise, in IFRS is allowing it, then why revised schedule 6 and Ind AS does not allow? They allow only nature wise. And the funny part was, as I saw, AS was allowing both nature wise and function wise. So what is the reason behind nature wise? Let's take the logics of both. The logic, Indian accounting Ind AS standards don't give very specifically for excluding function wise, but it is a very manufacturing company focused approach, and therefore the nature wise P&L only has been allowed. And if you take my personal views, in India today 66% of the GDP is contributed by service sector, and for service sector the function wise P&L is more suitable. Let me give you an example. If you are doing accounts or the balance sheet P&L of an information technology company, let's say Infosys or Wipro or TCS, they are putting revenue, then they are supposed to put cost of material consumed in the nature wise, purchases, etc., and they have to put salaries. Now can you imagine a difference between a manufacturing company and an IT company? This could be 100 in both cases, this could be let's say 70, and this could be maybe 0 almost. IT company has no material consumed, and this could be let's say 10, and here this could be 60. Is there any sense in calling this as a P&L account which discloses the picture properly? If you try to compare this company, some MBA management analyst will say that this company B, is spending 6 times more on salaries, and which will be a foolish analysis. And that's where I am a strong proponent of function-wise analysis. Luckily, President Gopal Krishnan sir is here. I would request him to take the note of these thoughts, because our costing institute at least must fight for the function-wise P&L account. That gives the proper disclosure. Then we come to a great funda called as other comprehensive income. I know at least more than 50 to 100 people, or maybe more, 200-300 people, those who are listening are my IFRS students, and some of them have done it before. But 1st July 2012 the amendment has come, and the format has changed for other comprehensive income. You are not able to see this now. Just ask for it. So that you will be also able to see this. So this is the 1st July 2012 amendment, which does the classification between may be reclassified and will not be reclassified. ये लोग को पाव नहीं चाहिए screen. ये क्या हो रहा है ना, ये लोग नहीं देख पा रहे स्क्रीन.
You want to show the presentation?
To them, yeah. Also, I mean others as well as them. Yeah, right. So items that may be reclassified to P&L account and items which will not be reclassified to P&L account. This is also bringing in a huge difference into the disclosures. As on today, if at all there is one thing short which IFRS has it and the revised schedule 6 doesn't have, is the other comprehensive income. We are going to deliberate it later, but this format clearly tries to change some very important thing which is called as a normal business and other than normal business. The funda behind OCI is other than normal business. You can see here forex operations, cash flow hedges. Many of the people here have also just come back from the CA final exams. So those hedge and derivatives must be on the top of their mind. Similarly, revaluation reserve, defined benefits, investments which are done in the equity and the liabilities, they are all going into other comprehensive income, and which makes a total comprehensive income. Now this is another format which is called a statement of changes in equity. If somebody asks you why this is for, simple, same answer. That is, if somebody tries to make some off balance sheet items or direct, the purpose of SOCIE, and you will not find this written into any book. You will find it only in the basis of conclusion given under IFRS and IAS. That is, if people adjust assets and liabilities directly into the balance sheet and reducing the profits in the balance sheet directly, then SOCIE is the tool to find out such a kind of manipulation. So this has been created deliberately, and this also ensures that a lot of chori doesn't get done. This is done for 2 years. Equity share, retained earnings, and all the OCI items. When one adopts the accounts for the first time, there are numerous optional exemptions given. And then there are additional exemptions for specific sectors, oil, gas, etc. And then there are mandatory exemptions. Interestingly, when one does IFRS accounts, first of all, world over, people are doing IFRS accounts. So where does India need to do IFRS accounts? Wherever you want FDI, you already need to do IFRS accounts, whether the Indian government currently requires or not. If we have overseas holding companies, what we call them as MNCs, then again we have to do the IFRS accounts. If we are going for equity investment from NRIs, then again we need IFRS accounts. And the next is that if we are going for some mergers and acquisitions, we need IFRS accounts. Coupled with that, there are many situations where we need IFRS accounts. Take for example Standard Chartered Bank. It is required to do IFRS accounts because it is a part of the big Standard Chartered all over the world. Then you might have heard about AIM, Alternative Investment Market, which is available in Europe. Wherever somebody wants to make his share tradability quite global, they go and try in this market. And when they try in this market, they are able to make their share price going up. At the same time, the compliance cost in AIM are low. Somebody wants to go in NASDAQ, ICICI, Infosys, Wipro. Somebody wants to go to NYSE. Somebody wants to go to Canadian Stock Exchange. Dubai Stock Exchange again is common. Brazil Stock Exchange is common. Can Indian companies spread themselves in all these countries? They are already spreading. And these countries' balance sheets demand for IFRS balance sheets. So, howsoever we may say, to my knowledge, 57%, and this is the published statistics available on Google, 57% worth value of companies are already in the process of doing their IFRS balance sheet. So people who are remaining away from IFRS, better take a note that they will be missing